Hello, and welcome back to Explain the Charts, your go-to channel for in-depth technical analysis. Today is October 27th, 2025, and we're analyzing the Nasdaq 100 ETF, symbol QQQ. The market is entering a pivotal week, and the news sentiment is cautiously optimistic. Wall Street is abuzz with reports that lower-than-expected consumer inflation could pave the way for the Federal Reserve to continue cutting interest rates, which is generally bullish for growth stocks in the Nasdaq. We also have a barrage of big tech earnings on the docket, which will be a major catalyst for QQQ's direction. Adding to the positive sentiment, there's renewed optimism for a potential US-China trade deal, with the Dow Jones rallying on the news. However, it's not all smooth sailing. We've seen volatility from reports of potential trade war escalations just last week, and sanctions on Russian oil companies have caused a surge in energy prices, adding an inflationary wildcard. Now, let's see how this news landscape translates to the price action on our daily chart. Looking at the bigger picture, QQQ has been in a powerful uptrend for well over a year, consistently setting higher highs and higher lows. The price action recently culminated in an all-time high around the $618 level just last week on October 24th. This demonstrates strong underlying bullish momentum in the market. However, this climb has not been without significant pullbacks. Notice the sharp correction in early April, where the price dropped from around $476 all the way down to the $402 level before recovering. More recently, we saw another aggressive sell-off on October 10th, where the price plunged nearly 3.6% in a single day on massive volume. That drop found support around the $589 level, which has now become a critical line in the sand for the bulls. Let's zoom in on the action since early September to get a clearer view of this recent volatility. Here we can see the strong run-up that pushed QQQ past the $600 psychological barrier for the first time. The momentum carried it to a peak of around $613 before that massive red candle on October 10th. This candle represents a significant reversal, likely triggered by profit-taking and fears surrounding the US-China trade situation that flared up around that time. Following that drop, the price based around the $590 support level and began a steady climb back up. We then saw a test of the $612 level around October 21st, where the market hesitated and pulled back again, dropping to around $605 on October 22nd. This established $612 as a minor resistance level that needed to be overcome. The last two trading sessions on October 23rd and 24th showed impressive strength, breaking decisively through that $612 resistance and closing at a new all-time high. Now let's switch to the 1-hour chart to analyze the texture of this most recent breakout. Here we can see the price action following the low on October 22nd. The market based around the $600 to $605 area before making a decisive move upwards on October 23rd. Notice the steady series of higher highs and higher lows on the hourly candles, indicating strong and consistent buying pressure throughout the sessions. The breakout above the previous resistance at $612 was clean and backed by solid volume. The price then consolidated near the highs, which is a constructive sign, suggesting that buyers are absorbing any profit-taking without giving up much ground. This short-term price structure is decidedly bullish and points towards a continuation of the uptrend. Drilling down even further to the 15-minute chart for last Friday, October 24th, gives us an intraday perspective. The market gapped up at the open and pushed strongly towards the $618 level in the first few hours of trading. After hitting a peak of $618.42, the price pulled back slightly and spent the rest of the day consolidating in a tight range between roughly $616 and $618. This price action is very healthy for a breakout day. It shows that after the initial explosive move, the market was comfortable holding near its highs, indicating a lack of significant selling pressure. This intraday consolidation builds a base for the next potential leg up. So, let's go back to the daily chart and recap what this all means for traders. Your key resistance level is the new all-time high at $618.42. A sustained break above this level on high volume would signal a continuation of the primary uptrend and open the door to further price discovery. To the downside, your first level of support is the recent breakout area around $612. Below that, we have the low from last week at about $605. The most critical support level to watch remains the low of the October 10th flash crash, right around $589. A break below $589 would be a major warning sign and could indicate a larger trend reversal is underway. Now for our unbiased prediction. The bullish scenario seems more probable right now, perhaps with a 70% likelihood. Given the positive macro news, the powerful trend, and the strong recovery, the path of least resistance appears to be higher. Look for a consolidation above $612, followed by a test and break of the $618 all-time high, especially if big tech earnings come in strong. The bearish scenario, with a 30% probability, would be triggered by disappointing earnings reports or a negative turn in geopolitical news. In this case, a failure to hold the $612 support level would likely lead to a test of $605 and possibly a full retest of the major support at $589. So, the things to watch for this week are simple: the Federal Reserve's commentary on interest rates and, most importantly, the earnings reports from the mega-cap tech companies that dominate the Nasdaq 100. Trade safe and watch these levels closely. And finally, a quick disclaimer: this video is for informational and educational purposes only. The content provided is not financial advice. Trading and investing involve significant risk, and you should always conduct your own research and consult with a qualified financial professional before making any investment decisions.